Now let's move our attention to sovereign and non-sovereign bonds. Sovereign means the government bonds, right? So majorly here, our discussion is going to be on the same lines as we did in the previous reading. So it's nothing new here except few minor details. So I'll quickly go through this part where if you all are aware that, bonds are issued by various corporates, by various organizations, and sovereign bonds are issued by the central government, right? By the main government, right? And then there are non-sovereign bonds, which can be like the quasi-government bonds, or the bonds which are issued by the state or by the county, and so on, right? Apart from this, we will also discuss on the bonds which are issued by supranational organizations. Are you aware about this, right? We discussed that in the previous reading in the part of issuer. I'll just recollect everything. Right? Supranational, sovereign, non-sovereign, and quasi-government. So these are the four major types of bonds apart from the corporate bonds. That's what our discussion here is. So sovereign bonds are issued by the central government. And why would government need money? Well, first of all, government needs money for short term as well as for long term, like a corporate. In short term, the government needs money to pay for the salaries of the employees, to pay for short-term needs, short-term operational needs, right? Then in the longer term, governments may need money for long-term projects, for infrastructure projects, for defense projects, and so on. So governments have their spending needs. Now, what happens here that most of the governments are always on a fiscal deficit, wherein they don't have enough revenues in the form of taxes to meet out their expenses, correct? So what is fiscal deficit? It's a situation where your tax revenues are more than your expenditure or less than your expenditure? Less than your expenditure, right? And that's the reason why you have to fund this deficit by borrowings. So governments regularly do borrowing, of course, with the help of what we just saw, auctions, that's through the central bank. So government does do a lot of borrowings in the market, domestic as well as foreign borrowings, right? But which borrowing is safer and which borrowing is said to be relatively, less riskier for the government? That's the domestic borrowing, because it's in domestic currency, right? Which government can pay at any time. So this is the reason why the governments always fund their deficits by borrowings. And that's the reason why governments keep on issuing bonds regularly. The bonds which are issued latest, they are called on-the-run securities. On-the-run securities. For example, let's say US government issues various treasuries during a year. Treasuries is a government bond in US, correct? So US government issues treasuries during the year, various treasuries. The recently issued treasury is called on-the-run treasury. Is that correct, everyone? The recently issued treasury is called on-the-run treasury. On-the-run means the recent one. That's going to be our benchmark. So government may issue a lot of bonds for, let's say, a maturity of 5 years, but the one which is recently issued is going to be my benchmark. Clear? Right? Now, the same government bonds which are called as by default treasury is what we know, but treasury is a word for US government bonds. There are some minor differences in the names. For example, the German government bond is called Bund, B-U-N-D. If you all are aware, that's the reason why German central bank is called Bundesbank. And then in India, we call it as GSEC, government security in short form, right? So there are various terms used in various countries, but most of them mean the same thing. That's they are the bonds issued by the government, correct? By the sovereign authority. Right. Names may also vary depending on the original maturity of the sovereign bond. So it depends on where it is issued and all, right? Now, a short difference between T-bills, T-notes, and T-bonds. It's only about maturity. So T-bills are those of this is where we understand that the names vary due to maturity. So they are all government securities, but in US specifically, any security which is less than 1 year is called treasury bill, T-bills. The security which is above 1 year but less than 10 years is called T-notes. And those which are very long duration bonds, which are long-term bonds, more than 10 years, 20, 30-year government securities, those are called T-bonds. So bills less than 1 year, notes 1 to 10 year. and bonds more than 10 years. Is that clear? Now we all are aware that securities which are issued for less than 1 year are issued at dash and redeemed at dash. Come on.
Discount and redeem at par.
Yes. So less than 1 year security, which is T-bill, is a pure discount bond. Pure discount bond means it's a zero coupon bond, right? So it's issued at discount and redeemed at par. But securities which are more than 1 year, they do pay coupon, and that's why you will see these securities as coupon bonds. So you will have coupon on those securities which are above 1 year. Clear? Now, when it comes to credit quality, well, do I need to say what is going to be the credit quality of government bonds? What do you think? Of course, it's going to be the best of all, right? So credit quality of sovereign bonds, even though they are, for your kind information, these are unsecured obligations. Okay, so they are unsecured. They don't have a claim on specific asset of government. So sovereign bonds are unsecured obligation. However, their credit rating are said to be the best. Credit rating agencies make a distinction between bonds issued in sovereign's local currency and in foreign currency. So as I just said, what would you think is less riskier for the investor, the bond issued in local currency or in foreign currency?
Local currency.
Remember,
Local.
yeah. Why? Remember that example of magic wand? Governments have that magic wand of printing currency, but their local currency, not the foreign currency. So if a government is issuing foreign currency, it may not have or not enjoy that high credit rating as it would have for a domestic currency. Clear? Sovereign bonds issued in local currency carry a higher credit rating compared to those issued in foreign bonds. Highly rated sovereign bonds are denominated in local currency and virtually said to be risk-free. Absolutely risk-free, because especially for domestic investors, because they don't have to be worried about the government being unable to pay their bonds. A liquid and freely traded local currency may also attract foreign investors to invest in sovereign debt. So yes, if you are a US citizen and dollar is your domestic currency, but that dollar is so freely traded that even the foreigners would feel, even the foreign nationals would feel that dollar is more liquid, and therefore they may see the US dollar denominated bonds also as risk-free. Clear? Right. Now, quickly understand what are the types of sovereign bonds. First of all, you have the coupons that they pay, maybe fixed rate, floating rate, and inflation linked. Most of the bonds are going to be, most of the government bonds are they are always fixed rate bonds, because forget government, it's even corporates. No one wants to have their liability floating. So they all want to issue fixed rate bonds, especially as I just said that less than 1 year are going to be zero coupon bonds and above 1 year are going to be coupon bonds. However, there are some national governments which have issued floating rate securities also. Germany, Spain, US issued first floating rate security in 2014. Can you believe before 2014, US government never issued floating rate bonds? They did that first in 2014. Belgium and in developed markets, Brazil, Turkey, Mexico, they have all issued floating rate security. But however, there are some large economies like Japan, UK, they have never issued floating rate bonds. So very few countries issue dash bonds. Which bonds? Floating rate bonds. And even if they issue, they don't issue it regularly. However, there are inflation linked bonds which are offered by the government quite regularly. So inflation linked bond, which is in US called as Treasury Inflation Protected Securities, TIPS, US TIPS is the most famous security out there. And they give coupons based on the consumer price index, based on the retail inflation. There are two types of inflation, CPI, consumer and wholesale price index. So there the inflation is based on retail prices. So as the consumer price index increases or decreases, your bonds inflation, your bonds coupon will be changing accordingly, right? So they are going to provide you more like an inflation hedge, correct? So anyone who thinks that inflation is going to rise, they can probably invest in such bonds, right? These are bonds which are also recently issued in the Indian markets, but unfortunately they have not been that hit as they were supposed to be, because very ironic that India faced huge inflationary situation a couple of years back, and then the central bank decided, let's come up with an inflation bond. But ever since they came with inflation bond, our inflation has been relatively low. And you know what? There is also one more problem in our economy, that the inflation that is published by the government and the inflation that we feel on the ground in real terms, right? That's quite different. So the government says that the inflation is, 2%, but I am sure no one is going to believe that in India. The things that we spend money on, they are all increasing by 10, 20, 30% a year. So there's a big gap between what is published and what do we actually get affected with. So that's the reason why inflation index bonds are not too lucrative as of now in India. However, just for your information, Argentina, Brazil, and Israel, they were the first ones to issue the inflation index bonds. Clear, everyone? Okay. Now, one more thing I would like to display here, that when governments come up with bond issue, credit rating agencies do rate them. But these rating agencies also look whether the bond issue is for short term or for long term. Whether the bond issue is for short term or long term. Okay. So on my screen, I hope you all can see. Visible? Everyone? Is my screen visible, guys?
Yes.
Yes, sir.
Okay. So here, if you can see, this is the S&P's listing or the credit rating of bonds, long-term and short-term, and within long-term and short-term, foreign currency bonds and local currency bonds. So foreign currency bonds and local currency bonds. Now, ironically, you would see that whether it's a foreign currency bond or a local currency bond, their credit rating almost looks like same in most of the bonds. In most of the bonds, I'll show you that the credit rating is same, but that can drastically change. Okay, it should not be exactly same as it is displayed here, but that there can be a substantial difference at times. So here you can see United States enjoys a AA plus credit rating, whether it's for foreign or local currency, because they mostly issue bonds in dollar only, right? That's the same case with UK and other European nations. US was enjoying a AAA credit rating, but that has been, that has been tarnished after the subprime crisis. So it's Germany, Switzerland. These are the countries which enjoy AAA credit rating as of now. Okay. So Germany, Switzerland, Australia, they enjoy AAA credit rating. Otherwise, most of the countries are, do you recollect what is India's credit rating? Everyone?
Yes.
We are at the edge. You remember that?
BBB minus.
Triple B minus. Why do I say triple B minus is the edge? Because that's the last point of investment grade bonds. If our rating goes one notch down, we'll be below investment grade, and then institutional investors will pull out money from us. Okay. So we are at that edge. Clear, everyone? So that's how the ratings are published: domestic, foreign, long-term, short-term. Correct. That's all about sovereign bonds. Sovereign bonds issued by the central authority or the central government. Now, then there are, provinces, regions, or counties. They also come up with the bond issues. They are called non-sovereign government bonds. As I said, they are issued by governments of provinces, regions, states, and cities. These bonds are typically issued to finance the projects, the local projects, maybe a dam, maybe a road, maybe a school. So various projects taken by the local authorities, those are of water management, water resource management, waste management. Most of these are issued to fund their social projects. So these are bonds typically issued to finance public projects such as schools, motorways, hospitals, bridges, and airports. Non-sovereign bonds are not guaranteed by the national government. However, they are still recognized to be virtually risk-free. However, non-sovereign bonds still receive higher credit rating, and they usually trade at a higher yield. Of course, their risk is slightly higher than the sovereign bond or less than. They slightly trade at a higher yield and, of course, lower price than the sovereign bonds. Clear? So of course, they are very much risk-free, but slightly riskier than the national government bonds. Clear? How would they pay me back? Well, for whatever project they have issued the bonds, they will get cash flows from that project, and that cash flow will be utilized to pay the bond investors, right? For example, taxing authority of local government, they do collect penalties and tolls, right? Toll collection from the roads. The cash flow of the project, yes, as I said, toll collection, that can be the important cash flow of the project. Special taxes and fees established specifically for making this type of payments. So many state governments in our country also have state taxes. Those state taxes are going to be the resources to pay back the investors. Is that clear, everyone? For example, we have some specific state taxes, extra taxes for the distribution of alcohol, or even for the petrol prices and all. So state governments do levy additional taxes which they can use for their fiscal deficit. Is that clear? Non-sovereign bonds, correct? Any doubts, anyone?
No.
Okay. Guys, tell me one thing. What is ITC? ITC, an Indian company, Indian Tobacco Company. Who owns that company? Any idea? Everyone out here? Who owns ONGC?
Government companies.
These are government companies.
Yes.
In the same way, there is Abu Dhabi National Oil Company, Saudi Aramco. Do you think these are government companies? If they are government companies, why are all people not hired by the government only? Why are they listed? Why can I buy and sell the shares? Well, technically, they are exactly not a government company. They are called as quasi-government companies. They were set up by the national government, but now they are a good combination of public and private company. Why? Why do I say so? Because they don't work like a government department, but they do hire and fire employees as a typical corporate, right? So these organizations have characteristics of both a public and private sector. They are not actually government entities. They are like a public company, but since they were set up by the national government, or the major stakeholders can be the national government, so they are so called as the quasi-government bonds. They are called as the quasi-government, entities. Okay. So I cannot say that ITC, or for that matter, ONGC or Aramco or ADNOC, these are not, we cannot say them as government companies. We use a word in India called PSUs, public sector undertakings, right? They were started by the governments, but now they are more like they have, of course, they are still controlled by the government to a larger extent. The policy making is influenced by the government. In many cases, even the heads of the company are being appointed or selected by the government, but they do work like a private sector. They do work. They do have an organization where they do have an organization structure more like a private sector. So it's a blend of both. Okay, such institutes are called quasi-government entities. In US, there is Freddie Mac and Fannie Mae. These are housing national organizations. They are sponsored, or they are, I can say, they are originated by the US government, but they are not the US government companies. They are not the US government specifically. So quasi-government entities, they issue bonds to fund specific financing projects, and these are called quasi-government bonds, right? So these bonds issued by these entities, they are called as quasi-government bonds. Of course, we know that they are backed by the government, but not guaranteed by the government. That's the difference. What do I say? They are backed by the government, but not guaranteed by the government. So I know if something goes wrong, government will bail out these companies. Am I correct? Right? So they may not be guaranteed, but government can bail out these companies. Are you getting my point, everyone? Therefore, they do enjoy a better credit rating compared to the other organizations, right? So quasi-government bond may be backed by collateral, but that's not always the case. Generally, there is no explicit guarantee by the national government, although investors presume that there is an indirect guarantee in the form that they will be bailed out by the government, right? Usually rated very high because of extremely low history of defaults, but the yield is definitely going to be higher than the sovereign bonds. So of course, their yield is going to be slightly higher than the sovereign bonds, but still it's considered to be relatively less than a typical private sector or a corporate bond. Am I clear, everyone? Correct. Everyone clear with sovereign bonds, non-sovereign bonds, and quasi-government bonds? Everyone?
Yes.
Yes.
Finally, you have bonds issued by supranational organizations. These are organizations which don't have a jurisdiction for a particular country. They hold, I can say jurisdictions over various countries like World Bank, IMF, a European Investment Bank, or Asian Development Bank, African Development Bank. These are organizations which have, which are run in multiple countries. They fund projects for various countries. So when they issue bonds to fund probably, let's say, some development projects in various countries, maybe for slum rehabilitation, for maybe for aid against the hurricane or against the floods and against the pandemic and so on. So these guys, these institutions issue bonds. They are called supranational bonds. They are very highly rated, and they are issued by these multilateral agencies, which we just discussed. Typically, they issue a plain vanilla bond, which is like a fixed coupon bond where the coupon is paid regularly, and on maturity, you get the principal back. Although floating rate bonds and callable bonds can also be issued. World Bank frequently issues large sizes of bond issues, and they often can be used as a benchmark by others. So, people use US Treasury as a benchmark. The securities issued by World Bank can also be considered as a benchmark in many cases. Clear? So those are the primary four types of, I should say, non-corporate bond, like sovereign and non-sovereign bonds. Everyone clear with this? Right? Now, well, we discussed about how sovereign and non-sovereign authorities can get money. But how would a corporate get money? That's what we now need to focus on. So the different types of corporate debt. So if you and I run a company, unlike the government, which has easy access to funds, if you and I are running a company, what are the resources that we have to arrange for funds? Well, to arrange for bonds, basically. Well, the first resources go to the bank and get a loan, right? So that's the primary resource, I should say, bank loan or syndicated loans. What is a bank loan? You go to the bank, typically give up your documents and give up some collateral, and you may get a loan. So bank loan is a primary source of debt financing for most of the companies, including small and medium-sized companies. Even large companies in countries where bond market is not that greatly developed, they also go for banks as a primary source of funding. So a bank will give you loans which can be fixed rate or which can be floating rate. Most of these loans are variable loans. So the interest rates keeps on changing based on the reference rate, like LIBOR, right? These loans can be a bilateral loan wherein there is going to be single lender and single borrower. Okay. However, if the loan size is too large, let's say if I want to go for borrowing of $100 million, and if that is considered too much high by a particular bank, then it may form a syndicate. Syndicate means in this case, there will be multiple lenders for a single borrower. So there will be a lead bank, let's say State Bank of India will be the lead bank, and then they will they will rope in other banks, other 4 or 5 banks to fund this particular amount, right? That's called a syndicated loan. Bilateral loan, one-on-one. Syndicated loan, multiple lenders for a borrower. Is that clear, everyone? That's a primary way of getting funds for a corporate, isn't it, everyone? Now, if you as a corporate have a very high credit rating, a very high reputation in the market, and you have enough financial strength to pay back, then you should not, you don't need to go to the bank to arrange the funds. You can directly raise funds from the market. That's called commercial paper. Commercial paper is a way through which corporates can directly arrange funds from the open market. These are short-term unsecured notes issued to the public or via the private placement, issued by large credit-worthy companies through which they reduce their funding cost. Okay. So why would I go for direct issue? Because I don't need the mediator here like bank, because they're going to charge me for it. So here, overall, what happens, the interest is less than the bank loan, but more than the sovereign debt. Why? Because here the credit rating is generally better for the company, right? Used by companies to fund their working capital needs. Why? Commercial paper are generally issued for less than 1 year. CPs are generally issued for less than 1 year. So they fall under the money market security, right? They're issued to fund their working capital needs and at times the temporary source of funds prior to longer term debt called bridge financing. Yes, this is very interesting. So let's say I am constructing a plant and the plant is of, let's say, $20 million. Now I need a $20 million of funding. So if I go in the market to raise funds or to arrange for funds, it will probably not happen overnight. Am I correct? Do you easily get funds? Today you need funds and there is an online app which directly gives you 20 or $100 million. Well, not really. A lot of times you see those ads on the local trains, right? They have written there that get funds in 5 minutes. Have you seen something like that? Well, I've seen a lot, but you don't get such funds easily. Okay. And even if you get, you have to be skeptical about it. So I'm just trying to say here that, if I need 20-30 million dollar of funds, it's not going to happen overnight. It will take time. The process, the documentation and all may take time. Okay. But till that time, I can't stop making my plant. So I temporarily need funds to start the project and till the time that I get the large funding. So that is called bridge financing. Are you getting it? Everyone? Got it? What is bridge financing? Bridge financing is that short-term financing you need right now before you get the large financing. Is that clear, everyone?
Yes.
In many cases, this is also called mezzanine financing, which is like before you prepare for the IPO, you may require funds to make your company compatible to the IPO. So here the maturity ranges from 364 to 90 days, and the most famous in US is 270 days. Commercial paper, 90 days is the most famous in US, my mistake, but 270 days is the maximum which is issued in US. Overall in the world, you can have a 364-day commercial paper issued. Commercial paper is often reissued or rolled when it matures. Very interesting. What does it mean? For example, let's say I have issued a 90-day commercial paper. So I have arranged funds for 90 days. But these are interval funds. Interval funds means that after 90 days, it will automatically roll out for another 90 days if you don't withdraw. Are you getting it? So these are rolling funds. So how will this help to the company? The company may not have to again go to the market, raise funds. If people want to stay reinvested, they simply don't have to withdraw. It will automatically get reinvested for another 90 days. Are you getting my point, everyone? Correct. But here there's a twist. If people do not want to roll over, then the company may all of a sudden face a credit crunch. That's called rollover risk. What is a rollover risk? Rollover risk is the risk that the company may not be able to generate funds once there is a rollover. So what if people withdraw instead of reinvesting? They withdraw. Then the company may all of a sudden face financial crisis. And that's the reason why we generally recommend companies to have other lines of credit also available. You don't be dependent on a CP only. You should have other lines of credit. However, that's a very rare thing with a healthy company. Is that clear, everyone?
Yes.
Correct. So does the CPs have credit risk? Credit risk? Yes, investors do face credit risk depending on the issuer's credit worthiness. Well, you and I know that if a CP is issued by a company like Apple, or CP is issued by a company like Tata Capital in India, it's hardly going to face a crisis, because the credit worthiness of the issuer is very here. The issuer's credit worthiness is very high. The credibility is very high. Ratings provided by the credit agencies help assess the CP's credit quality. In order to get an acceptable credit rating from the rating services, as I said, the commercial paper issuing corporates, they cannot be completely dependent on CP. They need to have something that we discussed called the backup lines of credit. Right? These are additional arrangements that the companies have in case if the funds are not available. In case if the CPs are not being in the position to get rolled over. Are you getting my point? So if the companies need funds, do you have any backup resource? If you have a backup resource, then you enjoy a better credit rating. Is that clear? Correct. So as an investor, why would I invest in a CP? First of all, they are for less than 1 year duration. Second, they are issued by corporates which have high credit rating. Am I correct? Therefore, there is lesser credit risk here. And third, the volume is very high. So there is enough liquidity because there are so many issuers, and the market is much, I should say, much liquid for CPs relatively. So here, there's enough liquidity for an investor to exit, right? This is the point where I say that CPs are considered to be, considered to be much better instrument for investors when they especially want to invest for less than 1 year. So they do get you better yields. Of course, the returns on the CP is going to be more than the treasury bills because they are slightly riskier than the sovereign bonds, but they are not as riskier because they are issued by organizations or corporates which have high credit rating. Is that clear? Now, CPs which are issued in US are called US CPs, but CPs which are issued outside US, anywhere in the world, they are called Euro CPs. Is that clear? So Euro does not, as usual, does not mean only the ones which are issued in Europe, but those CPs which are issued in US or in US dollars are called US CPs, and those issued outside US are called Euro CPs. Right? Now, after this, we understood the two sources through which corporates can raise money. One is bank loan, and second is directly raising funds from the market through CP. Correct? CPs are for less than 1 year or more than 1 year?
Less than 1 year.
Less than 1 year. They are money market instruments. When companies issue bonds for more than 1 year, we call them simply corporate bonds. Okay. So CPs can be for less than 1 year, more than 1 year, it's called a corporate bond. So within the corporate bond, if they are issued for less than 5 years, we generally, it's not a, this taxonomy that I'm going to use, it's not a defined one. It's not a rule, but it's just been the trend that any security which is issued for less than 5 years, it's called short-term bond. Between 5 to 12 years, we call it as a medium-term bonds. Long-term bonds are those which are issued for 10 years or 12 years and above. But the interesting thing is MTNs, medium-term notes. These are bonds which are issued, which can be issued for anything. Medium-term means anything, by the way. It's very ironic that medium-term bonds can be those which are, or medium-term notes to be specifically. These are instruments which can be issued for less than, for less than 1 year, like 9 months also, and can range to 100 years. So medium-term notes are, what I feel, they are the most flexible type of an instrument that we say. It's just a name. There's no definition about it. So MTNs can have very long maturities. They carry floating or fixed rates. Basically, most of the MTNs are more than 1 year. Okay. MTNs are offered continuously to investors through the help of an agent, right? Or through the help of the dealer. So if you want bonds, you probably have to purchase it through a dealer or through an agent. Life insurance companies, pension funds, and banks are one of the largest buyers of medium-term notes. Why? Because they have liabilities for various maturities. So they need several types of bonds which are going to have some these type of maturity. So you may have a medium term note of, let's say, 18 months. You may have a medium term notes of let's say 7.5 years. Now such notes are very lucrative for an insurance or a pension funds. Why? Because they may have a liability coming at 7.5 years. They may have a liability coming at 18 months. So they are very they are very famous. Medium term notes are very famous with these organizations. So these large institutional organizations consistently inquire for medium term notes with their specific needs. Okay, so that's why they are very famous. They turn out to be lower cost option for the issuer because of the cost savings in registration and underwriting. So you don't have to deal with registration and underwriting. You don't have to go with a long-term process. You can keep on continuously issuing, shorter term securities or, mid-range securities. Is that clear? So these are the funding options for a corporate. We understood what are the funding options for sovereign and non-sovereign and what are the funding options for a corporate. Clear, everyone? 3, bank loan, CPs for less than 1 year, and corporate bonds for more than 1 year. Clear? Any doubts, anyone? Yes, anyone has any doubts?
No.
Why would you have doubts, everyone out here? Because you all don't even do the revision. You all don't even study, I'm sure. Then how will you all have doubts? How will you all have things to share? Okay, normally this is now not how my sessions work. I have, I really miss taking sessions in the classroom, and I'm sure even you all would be missing that.
Yes.
Unfortunately, that was the time when, of course, it was not 100 years back, but I'm just saying that there was a time where, you can see the faces of the students, whether they are attentive or not. You can interact with them. You can have their stories in the class of their experiences of dealing with such instruments and all. So I've had the privilege of, in my class, especially, when I take level 3 class, it wasn't surprising for me where half of the batch was of my age or elder to me. I had the privilege of a batch in UAE where one of my student, he was the most talented person, and talented, I mean that he was up to date with all the information that I was reading. He used to research everything that was going to happen in the next day in the class. So excited that guy was that he had done all the homework of all the research and the actual instrument. So here, when I'm talking about CPs, he had the name of all the CPs recently issued. And now you would be wondering, oh, he must be very much free and all, right? Now, let me tell you, he was handling a team of 300 people. He was the vice president of that oil-rich company. And you know what was his age? His age was 56. Are you getting me? 56 was his age. There was no loss of energy whatsoever, no loss of passion whatsoever in understanding the subject. And he had the maximum doubts in the class, maximum informations to all of us in the class. Trust me, I have learned more than teaching more in such batches. So that was one of the best experiences I had because of the passion by that student, because of the interaction by the student. Now, I somehow don't know that why is that missing in today's online sessions, or generally in the online sessions. Otherwise, that's a missing part, compared to an online and an offline session. Otherwise, it's a great thing to have a session in the class. But I mean, I've had that, ironically, I had that level of interaction in an online session. So I don't think so even online sessions are boring unless and until you all want to involve in it. If you all don't want to involve in it, then that's a different story. Then it's going to be just like, seeing a movie, which is a one-way dealing thing. I never feel that CFA, a course like CFA, which is so beautiful, can be learned in that manner. Still, I have to run my show, but let me tell you all that you all have some of the experience of dealing in bonds, dealing in equities, which I know from your profiles. So, I would encourage you all to participate. I'm sure there are many institutes where, forget encouraging about the participation. Most of the peoples are, blocked from, even saying a word. So, I do encourage, but I feel that somehow the trend has been lost. That spike has been lost in this online session. Otherwise, I have had the best experience in online sessions. Okay. So now, I know that's all. Sorry. Yes.
Spike will return.
So, sorry, I didn't get it.
The spike will return.
The spike will return. Wow. That's a very good thing to hear. And don't worry, I'll push and provoke you all. I'll continuously do that. So I love provoking students by emotional, sentimental, and some fear way, so that they come up with some interactions. But that's all because that's how we can have a 4 or 5 or 6 hour session. Otherwise, it's just going to be me speaking up, which is going to be very boring. Okay, because at times, when I see my videos back, when I finish everything, and when I see my videos, not more than 10 minutes I can survive my own videos. So not more than 10 minutes, trust me. After 10, I sit for at times, just seeing or for editing or something. After 10 minutes, I have noticed my eyes dropping. So I don't know how you can just listen. It's not possible. You need to be interactive. Maybe because I know these things, and maybe because I'm bored because of that, but or maybe because y'all are listening it for the first time, so y'all may be excited to learn it. So the first timer always enjoys it, right? But if you have some knowledge, then what I enjoyed few of my sessions that I saw the videos is when we had interaction, when we had discussion in the class, when we had some arguments in the class with regards to the concepts. I think those were the most interesting sessions, where even while listening, I was smiling, I was laughing. So that part of conversation is what I've always loved. And that's something that you will also like it when you go back and see those clips. Okay, so that's what it is. So now let's move to one type of instrument which actually I struggled a lot when I was in the industry. I could never understand this product. So there was this fancy product used by investment bankers when I was working in the industry. They used to say that we are selling structured products. Have you heard about this word called structured products? These are so fancy words that they are used. I believe that they are used to lure those, high net worth individuals, that we are selling a structured product. So structured products are also called as structured financial instruments. They are combinations of 2 or 3 assets made or structured or customized to offer it to the client, right? So structured finance instruments represent a broad sector of financial instrument. There is no accepted taxonomy. There is no defined thing for a structured instrument. However, most of these instruments typically have customized structure, and more often they have a bond and a derivative product. Most of these products have a bond or even an equity in many cases. But since we are understanding fixed income here, our focus is bond. So they may have a bond and a derivative instrument like a call or a put option. Are you getting it? So the typical cash flows from such instruments are linked to one or more underlying. They include the ones like ABS, asset-backed securities, CDOs, collateralized debt obligation. Well, we have not discussed about ABS and CDOs. We will be discussing that in the topic of securitization. where I'll discuss at length what are asset-backed securities. So these are various instruments which are called as structured financial instruments. Now I'm going to display few of them now, and I'll help you understand what are these products. But these products also include mortgage-backed securities, asset-backed securities, and so on, and they will be discussed at length when we do securitization. So your first type of the structured product is protected instrument. Well, from the name itself, you get a feeling. What does protected instrument means?
Hedge.
Hedged, or your principal will be protected, right? So very interesting thing. Let's say you give me $100. Okay. You give me $100 to manage your portfolio. And right now, the yield of a risk-free bond, zero coupon risk-free bond is 5%. So what is the present value of this? If I want to put today in that security to get 100 on maturity, how much will I put? 100 divided by 1.05, right? I'll put 95.23 amount in the security today. So how much will I get on maturity?
100.
100 for sure, right? Because it's a zero coupon risk-free bond. So today you give me $100. I give you an assurance that I will not at all lose your principal. And what else I can do? The remaining amount I can put wherever I want. I can put this amount by buying a call option. Call option, we learn in derivatives, call option is an option to buy an asset. So what is unique thing about a call option? That you have unlimited gains, but your loss is limited to your premium, which is this. So what can be the outcome on maturity if the markets are up? Well, definitely I'm going to get 100 from the zero coupon bond, correct?
Yes.
And something positive from this investment in options. Clear? Because the value will go up if the markets are up.
Yes.
However, if the markets are down, if the markets are bearish, the maximum I lose in the call option is this premium of $4. Am I correct? But my bond will still turn up to be 100 on maturity, isn't it?
Yes.
So this is a strategy where at any cost, I will at least recover my capital, that is $100. And there is a possibility of high upside if the market goes up. Is that clear? These are called capital protected instruments. Everyone, they guarantee you, they give you an assurance that your capital will be protected because they invest in a zero coupon risk-free bond. And beyond that is what they do, investment in risky assets, like buying a derivative instrument like call option. Is that clear? So at no point you're going to lose your money, but there is a chance of high upside potential. So even if, let's say, the markets increase by 10%, or let's say they increase by 5%. So you may get, you can just consider your premium increasing by 5%. So my premium is 4.7619 multiply with 1.05. So that's almost equal to $5. So $5 plus the 100 which I'm going to get, right? So my returns will be 5% from the overall investment. 100 from, I can say, from the zero coupon bond plus the 5% return from the stock market. But if the investment becomes zero, still I make my principal back. So the minimum return that you get is 0%, not below that, but the maximum can be anything. Clear? Looks lucrative or not? Looks interesting or not? I mean, in fact, you can create for yourself such an instrument where your principal can be secured and the upside can be, you can bet that in, buying derivative instruments, right?
Yes.
In fact, for us, if you don't want to invest in a government bond, you can probably invest in a good corporate bond, which offers you, let's say, 7% yield. In such a case, your amount of investment in call option would be increased. So you'll have more money to invest in the call option. So you can do that as well. Clear? Just be careful about managing the risk. Otherwise, this is a very lucrative way of making money. right? Now, protected instruments, they are going to protect your principal. But now there are instruments which are very risky. They are called yield enhancement instruments. What do I mean by yield enhancement instruments? These are instruments, these are bonds where you are putting money which are risky, where there is a risk involved. So you are going to get high returns, but you are also expected to lose a lot of money in case if there is a risk. So these instruments allow investors to seek high return by increasing the risk exposure. For example, we have CLN, credit linked note. Credit linked note is an interesting instrument. Here, it's like you are not taking the protection, but you are giving the protection. So let's say you are an investor and you wanted protection against a default. So you are willing to take insurance, and I am the one who's selling you the insurance. So I am the investor in the credit link note. I will invest in this risk. So if the bonds don't default, you, basically the protection buyer, you will keep on regularly paying me insurance premium, like a good coupon, high coupon. But if the bonds do default, then it's my responsibility to, repay you the loss. So they are the coupon offered here is very high because I'm taking the onus of the risk. So credit link notes creates a credit exposure for the investor in this bond by transferring the exposure from the issuer to, so basically the one who wants the protection, his or her credit risk will now be over me. So if the bond defaults, I will pay for it. But if it doesn't default, I'll get a good coupon. Is that clear? It's like investing in a high risky bond. Am I correct?
Yes.
So you're the
Yes.
CLN issuer, the one who issues the bond, the CLN issuer is the one who will want for protection. And the one who invests in this bond, that's me. I'm going to invest in such risky bond. So I take the responsibility of default. So the one who invests in the bond is more like a protection seller, is more like an insurance giver. So CLN allows the issuer to transfer the credit risk from one to another. The credit event can be, now in what case I may lose the money if there is a credit event. What is a credit event? What if there is a sudden fall in the credit rating, or what if the company defaults? In such a case, if there is a credit event, then the investor in the CLN will lose money. For example, let's say the bond's value was $100, but now due to some default or due to some credit downgrade, the bond's value has become $70. So who will bear this credit risk?
You, $30.
I means
The investor seller.
Investor.
the investor, right? The protection seller. So this $30 will be the loss that I will bear. So here the investor will receive how much? What is the par value? 100 minus the new value of 70. I will probably receive back only the default money, that whatever the default money is that I will have to pay up for it. So the investor will receive the par value minus the nominal value of CLN. So I will basically get only how much?
$30.
What is the value of the CLN now? 70, right?
70.
So I will lose a substantial money if there is a default that occurs. But if the defaults don't occur, I will get entire principal back. That is $100. So I invested $100 into it. So I'll get my $100 only if there is no default. If there is a default, the investor will get par value minus the nominal value of the CLN. So in that case, I may not get my entire $100 back if there is a default. So whatever is the loss, after the adjustment of loss, whatever is remaining is what I will get. So if there is a $30 loss in the instrument, so after that $30 loss, whatever is remaining, what is the nominal value as of now? So that will be adjusted from the par value, and the remaining value is what I'll get. Clear, everyone? So the investor will lose if there is a credit event. So whatever is a loss for the issuer or the protection buyer is what I will pay him or her up. Is that clear? These are called high yield investments or yield enhancement instruments, right? So completely contrary to protected instruments where you're protecting your principal, you're for that extra returns, you are taking the risk, right, everyone? Then you have participation instruments. Now, many of the institutions like insurance or pension funds, they are not allowed to invest in equities, high risk instruments like equities beyond a particular percentage. For example, let's take an example of a pension fund which is not allowed to put more than 10% in equity. Okay, so where is 90% of its money going to be into? 90% of its money is going to be in the bonds, right?
Fixed income. Yes.
Right. But this is where the investment bankers have come up with a loophole. So what do? And this, what I'm now going to discuss, can be prohibited in many countries. Okay. But some people do it because of the prohibition. They want to escape from that rules. So what I'm going to now say is not illegal, but it's structured in a way that, you get a loophole. So what happens here? Let's say a company now issues a bond where the coupon payment of the bond is not fixed, it's floating. Normally, the floating rate coupon is based on a reference rate called
LIBOR.
Here, instead of LIBOR, what if I take S&P index? Are you getting it? So the way the index will grow, or the way the index will give me returns, is the way I'll get the coupons. So can I say, technically I'm holding a bond, but indirectly I'm getting exposure to
S&P index.
equity, right?
Equity.
Correct. So in the name, in the books, it will show that I have done investment into debt security, but ideally I'm getting an exposure into equity. So this is the way I can increase more exposure to equities beyond the limit that is specified to me. These are called participation instruments. Here the underlying can be S&P index, can be gold, can be commodity, or can be anything. So these instruments allow investors to participate in the underlying assets. They don't offer you the capital protection. Okay, they are risk instruments like equities. Floaters can be considered as a type of participation. So here they are floating rate. The coupons are floating rate. Many structured products sold to individuals are participation instrument linked to an equity index, like I showed here. These create indirect exposure to a particular asset class such as equity, and hence may attract those investors, especially for those whom it's prohibited to directly have an exposure. Is that clear, everyone? Correct.
Yes.
So for example, I'll tell you one interesting thing. Okay, now there's a lot of talks going on, government banning and not banning Bitcoin investments, right?
Yes.
Okay, so let's say I issue a foreign bond in India, a foreign bond in India of dollars, and you all can subscribe to that bond by converting into from INR. So I issue a bond here, and the coupons, the returns that I will give you is going to be linked to the Bitcoin. Okay, so as and when the Bitcoin's returns go up and down, you will get the coupon in the same manner. Clear? So indirectly, I mean, in the books, what are you doing? In the books, you all are holding a bond. But technically, your exposure is to the Bitcoin. Got it? Everyone. So this is how you can escape the regulations. Clear? Now, don't blame me if something goes wrong. Okay? I'm not the one who's going to be into the legal mess. This is just, I'm just giving you all a piece of advice that you all can do this. So, you know what? Forget investing. Investing is, investing in Bitcoin is I should say, it's an outdated concept. Raise money from people so that you invest a big amount in Bitcoin. So make people invest in Bitcoin rather than you investing in Bitcoin. That's where more money is. Clear. And now if you would say that, oh, the government isn't allowing you. So I've given you an loophole of how you can do it. Clear.
Thank you, sir.
So let me know when you'll issue the bonds where the underlying is Bitcoin. Clear. In fact, many companies would do that. Many companies can actually issue bonds for saying that they are they need money for projects, and then they can park this money in Bitcoins and all. you have a lot of dummy companies on the exchange. Many of these companies have they do that. They just raise money for anything and then they invest into anything. They are like dummy companies. They are just paper companies, right? We have a lot of those. I'm sure Jay would be the one who would be aware about such companies, and he can advise us which are those companies which can do this thing. Okay. Interesting, right? Participation instruments. Yes. Now, ideally, a floating rate bond will give you more coupon when the rates increase, right? But opposite to that, someone who believes that the rates will go down, they go for inverse floater. What is inverse floater? Inverse floater will pay you when the interest rates go down, right? These are instruments created. Now, which instruments I'm talking? Leverage instruments. So here, I'm just not betting on the rates going up or down, but I'm also taking leverage on it. How exactly? I tell you. These are instruments. Leverage instruments are created to magnify the returns and offer the possibility of high payoffs. Inverse floater is one of the example. Here, as the reference rate decreases, let's say I've taken up here an example. Let's say the structure here is 12 minus the reference rate. Let's say structure is 12 minus the reference rate. So as of now, let's say the reference rate is 10%. So how much coupon I will get? 12 minus 10, 2%. But if the reference rate goes down, let's say if the reference rate turns up to be 8%, so I'll get more coupon, I'll get 4%, isn't it?
Yes.
Correct. Now here, what if I multiply the reference rate with a higher, higher term? Instead of 1, what if I multiply the reference rate with 2? So here, what will be the outcome? Not 2, basically the change. For example, how much did the interest rate fall when it went from 12 to 10? When it goes from 12 to 10, it falls by 2%, right? But that 2%, if I multiply with a factor, let's say instead of 1, I multiply that with 1.5. So now the fall has been actually only 2%. But how much will I consider? 1.5 times. So the fall is for me 3%. So this will turn out to be 9. So effectively now what will be I getting the coupon? For me, the coupon will not be 2%, but it will be more than 2. So if the fall is of 2%, I will only get 2% if
there is no leverage.
If there is no leverage. Very good. But if there is a leverage, then let's say if the fall is only 2%, and if the leverage is more than 1, if that is more than 1, let's say it's 2, then 2% into 2, I'll probably get more coupon. So you'll get more coupon if the leverage is more than 1. So here, if the fall is, let's say, if the fall is 3%, so 2 into 3, 6%. So 6% is the coupon I will get. Are you getting it? That's called leveraged coupon instrument or leverage instrument, where the leverage is more than 1. But if the leverage is less than 1, then 3 into 0.5. Less than 1, 3 into 0.5, which is hardly 1.5. So I'll get just 1.5 coupon. Clear? If the leverage is 1, it's a typical inverse floater. So there are two types of leverage instrument. The one which are actually leverage, where the factor is more than one. So for every 1% change in the reference rate, every 1% fall in the reference rate, you will get more than that in the form of coupon. Clear?
Yes.
But if it is less than one, but not less than zero, if it has to be less than one but not less than zero, then we call it as a deleveraged floater, deleveraged inverse floater. So inverse floater and deleverage inverse floater and leverage inverse floater, three types. A typical inverse floater is where the factor is 1. Leverage inverse floater will give you more coupon when the rates fall. Deleverage inverse floater will give you less coupon when the rates fall. Is that clear, everyone? Right? Any questions, anyone? So what were these? Yes, sorry. Yes, what?
How can we leverage a bond?
No, you can't leverage it. These are instrument issued in the manner where the factor of the coupon is leverage. Leverage means not taking a debt, but it's multiplied with a factor. So here it's named as leverage instrument, but that doesn't mean that I am taking money for bonds. No, my coupon is leverage multiplied. So that leverage does not relate to debt here. It relates to, you can say, the sensitivity or the risk. Okay. So these are different types of instruments. These are different types of investment options, which are unique and different from a typical instrument. That's why they are called structured products. Clear? Now we move our attention to banks. We understood what are the ways through which a sovereign or non-sovereign entity get funds. What are the way through which corporates get fund. Now our focus is on how banks can arrange for funds. Well, the very easiest way for banks to arrange fund is to
RBI.
Collect deposits. The primary thing is that they will collect deposits from people, right? Correct. That's called retail market. Retail deposits, where they can have savings or checking accounts, right? That's their primary source of funds for bank, isn't it? But beyond the primary source, when they need money at huge quantum, then they go for wholesale market. The wholesale market includes central bank funds, which you just mentioned, that getting funds from RBI or the central bank. The interbank deposit market, where banks can borrow with another bank, and CDs, certificate of deposits, are like commercial papers are issued by corporates. They are short-term instruments issued by corporates. In the same way, short-term instruments issued by banks are called CDs, or certificate of deposits. Clear? So let's focus on one by one. First of all, retail market, as I said, it's going to be demand deposits like checking accounts, or time deposits like fixed deposits, saving accounts. These are the ways through which banks generally arrange their primary money, the primary source, right? But when banks, as I said, need large funds, they will go for these sources. Let's take them one by one. Certificate of deposit. As I said, certificate of deposit is an instrument which is issued for more than 1 year or less than 1 year?
Less than.
Less than 1 year. So most CDs have maturity which are less than 1 year and pay interest on maturity, like a zero coupon bond. Clear? CDs with longer maturities are called term CDs. So if a bank is issuing a CD for more than 1 year, they are called term CDs. So here the yield, the returns on the CD depends on the risk of the bank. Okay. Mostly, if the banks are like a public sector undertaking, like a government bank, then the risk is said to be relatively lower because they are indirectly backed by government, like a quasi-government entity, right? Now, the yields that you get on this bond, as I said, are lesser if it's a less riskier bond. Okay. Now, there are two types of CDs which the banks issue. One is called a negotiable CD and another is non-negotiable CD. Non-negotiable means you cannot sell or transfer it to someone, or cannot withdraw it, before the stipulated time. If you want to, there is a penalty. So non-negotiable CD is like, you have put your money in fixed deposit in a bank and locked it. You cannot remove it. That's called a non-negotiable CD. And you can't sell this fixed deposit to someone else. It's in your name only. Clear? But a negotiable CD is like a bond. If I have subscribed to it, but in between, if I need funds, I can sell it to someone else. Okay. So typically more than 1 million they are traded in the domestic bond market as well as in the Euro bond market. So they are also traded in the foreign market. So for the investor, if I invest in the certificate of deposit of a bank, and if that's a negotiable CD, I may have invested for a 1-year CD, but after 2 months, if I want to sell it, I can sell it under the negotiable CD or non-negotiable?
Negotiable.
Negotiable one, right? That's more lucrative for the investor. Correct? So most of the CDs issued by banks are actually negotiable CDs because that gives investors more flexibility. However, if the banks want to issue non-negotiable, they can issue, but then the investor is locked till the maturity. Clear? Everyone? So your preference would be always to invest. Whenever you want to invest in a CD, you should always check that whether it's non-negotiable or negotiable. Now that's the one way through which banks can raise money from the open market or from general investors. However, central banks also fund the banks. So whenever banks need funds on an immediate basis, the central banks have opened up the window for banks to borrow from them. That's what we call the central bank funds. So central banks, every bank keeps some reserves with the central bank. What are those reserves called? We call them CRR or SLR, right?
Yes.
So for example, cash reserve, in India, every bank has to keep around 4% of their reserve with the bank, with the central bank. Am I correct?
Yes.
So that reserve is kept with the bank. SLR is, some form of investment you have to keep with the central bank, which is around, I think, 18 or 20%, if I'm not wrong. So banks have a substantial portion of their, collection of their deposits, which they have kept with the central bank as a reserve. That's why they always have access to this funds by the central banks at a very low rate. Those are called central bank funds, right? Now, generally, when banks keep money with the central banks, do they get any interest on it?
Yes.
Okay, now let me tell you, if it's a CRR, if it's a cash reserve ratio, in India, as far as I'm aware, about India, not about many other countries, and that depends from country to country. In India, if you invest in when you give your deposits to the central bank in the form of CRR, banks do not get anything, zero. And in SLR, banks do get some returns, which are very, very minuscule because they are virtually like, the lowest returns in the form of risk-free rate. So let's say if the CRR is 4%, so out of the $100 deposits that bank collect, they have to straight away put $4 of deposit with the central bank for which they are going to get nothing. And let's say if the SLR is around 18%, so another $18 is what they will make money less than what they have to pay to the depositors. Are you getting it?
Yes.
So technically it is 18 plus 4, 22 minus $22 if I say. So technically it is the $78 for the bank where they have to, lend and make profits. That's why banking business is so complicated in countries like India. Clear? So this interest on reserve funds, they hardly pay interest or no interest. As I said, for CRR, there is no interest. For SLR, there is very small interest. However, because of this, the reason that central banks do this is to protect the bank. And, in terms of crisis, you can get funds from the central bank. So they allow the banks to lend the surplus funds to the central bank and they can get it when they need it. Also called as overnight funds, where the maturity is 1 day, and term funds where the maturity is going to be more than 1 day, right? the interest rates on the central bank. So now if banks borrow from the central bank for, let's say, a smaller duration, in such a case, do you think that the central bank will not charge them? No, the central bank does charge them. So do you understand the arrangement here? Now it's an arrangement that I'm sharing with you all, but it's at times laughable, isn't it? Why? And this is my personal opinion, that I give money to you where you may not pay me interest. But when I take the same money from you, you charge me interest. Are you getting the bank's, the bank's feelings?
Yes.
So the interest on the central bank are short-term interest rates determined by the markets, but influenced by the central bank's OMO, open market operations. These rates are termed as central bank fund rates, which are called in US Fed funds rate. And they are decided by FOMC. FOMC is the Federal Open Market Commission, right? They are the ones who will decide what will be the central bank's rate. So what is Fed funds rate? This is the rate at which US banks can
Get the money.
Can get the money, right? Fed funds are traded between banks and other financial institutions globally and may be transacted directly or through money market brokers. So what is the central bank funds? Central bank funds are basically a window through which banks get money from the central bank. So US banks getting money from the US federal bank, that's called the Fed funds rate, or that's called the central funds rate, central bank's funds rate. Clear? Can I say this is going to be the lowest interest in the economy? Lowest interest in the economy, right? Because banks get fund from central bank, let's say at 4%. Then banks will give to the investors or to the borrowers at 4 plus some spread, right? So this is the lowest rate in the economy. Remember, central bank funds is the lowest rate in the economy for borrowing, because that's the primary source of your, you can say the primary source of the river is basically when the central bank lends to the banks, and then the banks will lend to the corporates or to individuals and so on. Clear? Anyone, any doubts? Now, interbank funds. Now the name itself has the meaning. What does interbank fund says? It's a rate at which banks will lend to each other in the interbank market. So interbank market is a market of loans and deposit between banks. The term to maturity of interbank loan deposit ranges from overnight to 1 year. So any bank which has excess funds, they will lend it to another bank maybe for 1 day or one. Why would a bank borrow for 1 day? For example, banks have to maintain on a, let's say on a weekly basis, some minimum ratio with the central bank. What if they don't have funds on that particular day? They can immediately get arranged 1 day fund, an overnight fund. So they can ask the other banks, do you have enough money for 1 day so that I can fulfill my commitments of reserve ratios? So that's the reason why there is a market for interbank borrowing also. Now, of course, this is an unsecured market. Borrowing between banks is unsecured, and the bank's credibility, the interbank's credibility will be very important here. So an interbank deposit is an unsecured. So banks placing deposit with another bank need to check, need to have an interbank line of credit in place with the institution. So you need to have the formal relationship with the bank. You need to have an interbank relationship with the other bank in case you need, short-term funds from them. In 2007-8, the interbank market had completely dried up. One bank was not willing to lend another bank. Completely collapse of interbank market, and therefore banks had to rush to the central bank for funds. Clear? So whenever there is risk in the banking sector, interbank funds will completely dry up, and then banks will have to rush to the central bank. So the central banks will then have to release liquidity in the market. Clear? Yes. Now there are some quick rates just for your reference, okay, not related to CFA syllabus. Because we are discussing about the bank and the bank related rates, I'll just use some terminologies here for Indian banking system. I'll repeat, these are not related to CFA exam. This is just from my end that I feel that, we should know that what are these rates. In India, we very much often use bank rate. Bank rate is the central bank's funds rate. It's a rate charged by central bank for lending funds to the commercial bank. So, for example, here when RBI lends money to banks, the rate that they charge is called bank rate. Correct? Now, so let's say RBI, gives money to the banks at 6%. So that 6% is going to be the bank rate, the minimum rate in the economy. Clear? Now, there is another rate which is called base rate. Base rate is the minimum rate set by RBI. No banks can lend to the customers below this rate. For example, let's say the base rate is decided at 7%. So of course, now the rates are very low, but base rate at 7% means no bank in India will lend to customer below this. They will lend at 7% plus a spread. Spread depends on the customer's credit score. But 7% is the minimum rate. That's a base. You cannot charge customers less than this. Is that clear? And finally, you have the call money rate. It is the rate at which short-term funds are borrowed and lent in the money market. So the borrowing and lending rate in the money market, which can be between banks or corporates, that's called the call money rate. It's a short-term rate which people use as a benchmark. So if you want to understand what are the short-term interest rates, check out call money rate. If you want to understand what is the minimum rate that banks will lend to customers, that's the base rate. If you want to check out what is the rate at which central bank gives money to the bank, that's the bank rate. Clear, everyone?
Yes, sir.
Yes, everyone. Now comes the last part of this section, that is called repo. Repo is what we are very much aware because it's actually a more used in the Commonwealth nations like UK, India, Australia, and so on. Repo, it's a short version for repurchase agreement. How does it work? It works in an interesting way where the one who needs funds, I'll directly go to the structures so that it can get connected easily. The one who needs funds, let's say I need funds. So what I'll do, I am a bank. So I will sell securities to you, to probably can be another bank or the central bank or anyone. I'll sell securities, let's say at $100. So you will buy security from me at $100, right? So I will sell you a bond of $100. You will pay me $100. But I promise you that I will pay you on maturity $100 plus the interest. So I'll probably pay you, let's say $105. So right now I'm selling you a security with a commitment that I will buy it back from you at a higher price. Now that difference between 100 and 105, that $5 is called as my repo rate, or you can say that's the margin. Is that clear, everyone? So that $5 is technically here the interest rate on the instrument. So here you are just not doing unsecured borrowing and lending, you are providing a security. You are giving a security and then taking it back at a higher price. So this is called a repo. Repo is an agreement where you sell a security with an agreement to buy it back at a higher price, which is fixed. In practical terms, a repo can be viewed as a collateralized loan in which the security is sold and subsequently repurchased. So isn't this much more secure than the CDs? Because CDs are unsecured, because interbank borrowing is unsecured, because central bank funds are unsecured. But repo is more secure. But why? Because I'm going to provide you security for getting funds. Is that clear? Now, what can this security be? This security can be reserves that the banks have in the form of government securities. This can be reserves in the form of gold or any asset that the banks have. Correct? So tell me one thing. Will the repo rate be higher or lower than the other instruments? Comparatively, will the repo rate be higher or lower than the other instruments?
Lower.
Lower, because it's a secured borrowing.
Secured.
Right? So here the banks who are going to borrow, or the institutions which are going to borrow, right now they are borrowing not without a security but with security, and on maturity the lender will give back the security and in return will get funds which are more than what they had given. So that extra is the interest here. Clear? Now there are few terms that you need to know when you are dealing with repo. For example, repo rate, it's the interest rate on the repurchase agreement. For example, I said you that, right now I'm selling a security at $100 and I'll get it back at 105. So 5% is going to be my repo rate here. Clear? The price at which I will buy back, that's called repurchase price. So here, what is the repurchase price going to be?
105.
Right. So that 105 is the repurchase price. The date, that is the exact maturity on which I'm going to buy, is called the repurchase date or repo to maturity. That's the duration of your repo. So repo to maturity is an agreement lasting until the final maturity date. So let's say the exact date when I'm going to take it back, that's called repo date, and the duration of this instrument. If I'm doing this particular transaction, let's say for 5 days. So 5 days is my maturity. Overnight repo is the term used when the repurchase agreement is for 1 day. So what is the overnight repo rate? Let's say it's 4%. So 1 day rate is 4%. Now remember, 4% is not for 1 day. So it's annualized. Are you getting? So it's 4% into, I've just used 105 for your easy reference, but in reality, it's going to be 5% for the maturity. So if the maturity is 10 days, so it's going to be 5% into 10 by 365. Clear? Okay, no one's going to pay you $5 for 10 days. Correct?
Yes.
Right? Term repo. So overnight repo are for 1 day, term repo are for more than 1 day. Simple. Clear? Now, what is a repo? Repo is the borrowing rate or the lending rate? Repo is the borrowing rate or a lending rate? Come on.
Lending rate.
It's a borrowing
rate.
Bank will borrow from you, or let's say one institution will borrow from another institution. That's why it's called a repo rate, right? But from the lender's point of view, we call it as a reverse repo. So what is repo for the borrower is called as reverse repo from the other side. Are you getting me? So what will be higher, repo or reverse repo? I mean, generally what is higher, the loan rate or the deposit rate?
Loan rate.
Loan rate.
Loan rate is higher, right? So keep in mind, if the loan rate is higher than the deposit rate, so you can also tell me which is the loan here, repo or reverse repo? The repo rate is going to be higher than the reverse repo. Are you getting me? Clear? I'll repeat, repo is going to be higher than the reverse repo because the loan rate is always higher than the deposit rate. Am I clear, everyone?
Yes.
Right? But as I said, repo is relatively less riskier. Why? Why? Because of the collateral provided. Second, because of the shorter term. Third, if the collateral is also transferred to your account, to the lender's account, then the lender will be more secured, right? So there are two ways. I saying that I have a collateral and I'm giving you a collateral. What is more safer? I telling you that I have the collateral and I'm giving you the collateral. What is more better? Well, I delivering the collateral is more better, right?
Yes.
So if you deliver that collateral, the lender will be more assured. So that's going to reduce the yield. Now, if this collateral is of very high quality or very scarce in the market, then the lender will be very excited to get this collateral. Let's say if I give you Bitcoin as a collateral, just hypothetically, then you'll be more excited, correct? So that's where the more the demand of the collateral, the more scarcity of the collateral it is, the lower will be the yield. The lender will be more than willing to give you, right? So if you want to have lower repo rates, the quality of your collateral should be very high. Lower the interest rates of alternative financing in the money market. So if the other options like central bank funds or interbank funds are also low, then the repo rate will be low. So under what conditions the repo rates will be low? If the collateral is provided is less risky, if the duration is less, if the collateral is delivered, if the collateral is very scarce in the market, right? It's of high quality. And if the other options are cheaper, then the repo rates will be low. Clear? So what is the credit risk associated? First of all, is there a credit risk? Is there a credit risk?
Yes.
Very less.
Yes.
The credit risk is there, but very less. The credit risk depends on the quality of the collateral. Okay. Now, let me tell you that I took borrowings of $100. And in return, I have given you the collateral, which is of $100. So I gave you a collateral, which was at $100 initially. That time it wasn't an issue. But later on, the collateral's value did fall. Let's say the collateral value is $80. Now, is there a credit risk? Yes or no?
Yes.
Everyone, how much is the credit risk?
$20.
The lender can lose $20, right? This $20 is called the repo margin. This $20 is called the repo margin. The lender can lose this $20. This is also called in the banking term haircut. Haircut means this is the money that the lender will lose in case if the borrower defaults as of now because the value of collateral has gone down. Clear? Everyone? Now, therefore, repo margins vary by transaction and are negotiated bilaterally. So as a lender, you have to properly check how much margin you're willing to give to the borrower. Would you want as a lender to give more margin or less margin?
No margin.
Less margin. Why? Because then the chances of default are, you will lose less money. So if the margin is more, the chances of your haircut, the chances of you losing money are high as a lender. Correct? So in what case you'll probably give more margins, or you'll probably be comfortable to give margins to the lender. So those are some of the factors where, listen to me carefully, the lender is willing to give more margin or willing to take more risk in what circumstances? The level of margin is the function of following factors. Shorter maturity. If the maturity is for less duration, then I'm okay with giving you more margins, right? If the quality of collateral is high, if the credit worthiness of the borrower is very high, and if the collateral is very rare or scarce in the market, in such a case, the lender is willing to give a higher margin. Higher margin means the lender is willing to give you loan for more than the value of your collateral. So even if your collateral is $70, the lender is willing to give you $100. The lender is willing to take the risk, the haircut risk, that the lender will lose money only if these are the factors, like the maturity is less, the quality of the collateral, and the quality of the borrower is high. Clear? Everyone? That's all about repo market, and that's all about this wonderful topic of fixed income market. It's a purely theoretical topic, but I'm sure I've gone in so detail of every theoretical aspect that you may not have to revise it again and again. You just read it once and it will be done. Everyone clear? In this market, in this particular topic, we've understood what is the global financial bond market and how the bonds are issued, primary and secondary market, private placement, public offering, and all. How are the ways through which sovereign bonds can be issued, non-sovereign bonds can be issued, how banks can arrange for money, how corporates can arrange for money, and what are the short-term funding options, what are the unique ways of investment in structured financial products, in form of structured financial products. Those all are the things which we covered in this topic. Clear, everyone? Right? Any doubts, anyone? Anything? Anyone?
In
Yeah, tell me.
in the supranational bonds, the
Sovereign,
yields,
supranational. Yes.
so the yields are slightly higher than the sovereign bonds or
No,
similar?
it's almost similar. In fact, sovereign bonds yields depend on country's credit rating. Okay. So
Mhm.
sovereign bond can, for example, if the government of Argentina issues the bonds, or the government of Italy issues the bond, or the government of Spain issues the bond, then the credit rating is very different than when a government of UAE or Qatar or US or France issues the bonds, right? So basically, sovereign bonds, not all sovereign bonds have the best credit ratings, right? But supranational bonds will always have the highest credit rating because they are never going to get default. They are always contributed by the member nations, so they will never default. So technically, they both may enjoy the same rating, but sovereign bond depends on the country.
Country.
Supranational bonds don't depend on a country. So if you're going to compare a US government bond or a German bond or let's say a Swiss bond with a supranational bond, then you will find no difference. But then when you compare an emerging market bond with a supranational bond, then the supranational bond will have less yield compared to the emerging bond. Clear?
Yes.
Good. Yes. Any more doubts? Anyone from this particular topic? Anyone? Yeah. Yeah. Tell me.
The last topic of the repo rates, you said there is a haircut margin
Yes.
where the lender is willing to pay, lend you the money more than your collateral.
Yes. Yes.
Does
So
this-
here that is allowed. Correct. So I mean, in fact, that's how the borrowing market works. Most of the borrowing markets work in a manner where the collateral value is less than the amount you require, mostly, except the home loan. In home loan, you know what happens, that you are taking borrowings for value which is less than your home value. You are being told to pay a 20% down payment. So
Yes.
forget the home loan and the auto loans and all, right? Apart from that, the corporate borrowing and lending, they are definitely most of the cases they give you borrowings more than the value of your collateral also. That's why they also charge you very high rates. That's the risk that they take, and that's why corporate borrowing, for example, right now in India, we know that if I want to go for home loan, I may get at 7 or 8%, but if I want to have the corporate loan, even with the best of the balance sheet that I have, I may not get that less than 14-15%. Correct? And that's why the risk there is that they are willing to pay me, they are willing to lend me more than the value of collateral that I offer. Okay, so that's the risk that banks do take. They lend you more than the value of a collateral. Now that risk is what is the margin, or that's the haircut that banks will take, or that's a default that banks will have in case the loss that banks will have in case there is a default. Okay. So commercial borrowing and lending is always more than the value of collateral. Clear? Yes.
Got it, sir.
Yeah. Yes. So any doubts, anyone? No? Okay. I'm sure these are theoretical topics, so there will be lesser doubts, but there will be handsome doubts when we go for reading 44 or 46 and so on, right? Okay, so now we'll move to the next reading.